The market is currently open for the regular trading session, and Lucid Group Inc., trading under the ticker symbol LCID on the Nasdaq, is currently hovering at 5.72 per share, representing a drop of 1.21% in intraday trading. While the broader indices are showing mixed signals, the real story here isn't just a minor percentage slide on a Friday afternoon. The immediate reality that completely upends the common market narrative is that the company is currently facing a massive, newly filed securities fraud class action lawsuit that covers the period between February 25th and April 13th of this year. While casual retail traders are watching the daily chart blips on their favorite self-investing apps, institutional investors are focused on a critical infrastructure failure, a severe supplier quality issue with the second-row seats of the new Lucid Gravity SUV completely halted deliveries for 29 straight days during the first quarter. This triggered a brutal mismatch between expectation and reality, leading to a production number of 5,500 vehicles, but a dismal delivery count of only 3,093 units. This single supply chain disruption forced the company to significantly miss its quarterly estimates, causing institutional money to pause and reevaluate the true operational capabilities of the luxury electric vehicle manufacturer. When you speak to most retail investors who frequent popular investing sites, the general expectation surrounding this asset is heavily anchored to its elite backing. The common belief is that because the Public Investment Fund of Saudi Arabia owns a massive majority stake through IR Third Investment Company, the business is effectively immune to traditional bankruptcy risks. People look at the sovereign wealth fund's multi-billion-dollar cash injections, like the $1.5 billion funding package consisting of convertible preferred stock and unsecured loans, and assume the company has an infinite runway to figure out its manufacturing issues. The expectation is that superior engineering, unmatched battery efficiency, and deep-pocketed backers will inevitably guarantee a spot at the top of the luxury electric automotive sector. This belief makes the asset a frequent target for retail traders utilizing platforms like Robinhood stock trading or the intuitive interfaces of SoFi Invest. However, the cold, hard reality of automotive manufacturing regularly clashes with this optimistic narrative. Having billions of dollars in the bank does absolutely nothing to fix an unauthorized supplier component modification that forces a 29-day total delivery freeze. When the company paused operations to inspect previously produced vehicles and reverse that unauthorized supplier change, it exposed a deeper vulnerability. The luxury automotive space is entirely dependent on seamless operational execution. No matter how much capital is provided, a car cannot be delivered to a consumer without safe, compliant seating. This operational bottleneck is precisely why the stock has experienced significant downward momentum, completely challenging the thesis that state-backed funding solves all corporate hurdles. Institutional traders utilizing an advanced interactive brokers platform look past the beautiful sheet metal and focus directly on these execution metrics, realizing that a failure to scale deliveries rapidly burns through even the largest cash reserves. Recent market movement highlights a severe tug-of-war between high-volume retail speculation and institutional distribution. Over the past 30 trading days, trading volumes have experienced sudden, erratic spikes, often driven by options flow rather than long-term equity accumulation. When looking at the capital flows across major individual brokerage accounts, from traditional platforms like Fidelity Brokerage to modern mobile ecosystems, there is a clear divide. Retail accounts have been net buyers on the dips, tempted by the stock trading near its 52-week lows, while institutional blocks are steadily trimming exposure. The fiscal first quarter earnings report revealed a painful financial miss, with revenue coming in at $282.46 million against Wall Street expectations of $358.51 million. This represented a substantial negative surprise of over 21%. Compounding the revenue miss, the net loss per share plunged to minus $2.82, missing the consensus estimate of minus $2.30 by more than 22%. This financial deterioration is a direct consequence of a ballooning cost of goods sold, which hit $594.17 million for the single quarter, alongside total operating expenses of $1.23 billion. When a company spends nearly double its revenue just on the basic cost of producing its vehicles before even accounting for research and development or corporate administration, the business model faces structural pressure. This massive operational deficit resulted in an operating loss of $951.55 million and an EBITDA loss of $835.14 million for the quarterly period. For investors utilizing advanced screening tools on the Interactive Brokers trading platform or researching through Fidelity Investments, these numbers highlight an unsustainable cash burn rate that requires continuous shareholder dilution to sustain. Every single vehicle rolling off the assembly line in Casa Grande, Arizona is currently being sold at a massive gross loss, which completely contradicts the traditional growth narrative found across online investing forums. To understand how the company arrived at this critical juncture, we have to examine its underlying business model and historical trajectory. Founded originally in 2007 under the name Adieva by Bernard Tui, Xiaoping Lin, and Sam Wang, the entity spent its early years focused strictly on developing advanced battery technology and electric powertrains. It wasn't until a complete corporate rebranding in 2016 that the organization pivoted toward becoming a direct manufacturer of luxury vehicles. The core strategy was built on leveraging their proprietary powertrain engineering to deliver unmatched vehicle range and efficiency. This technological foundation led to the launch of their flagship sedan, which achieved an unprecedented EPA estimated range of over 500 miles on a single charge. This engineering feat positioned the brand as a highly sophisticated competitor capable of challenging established industry players. The corporate strategy relies entirely on a direct-to-consumer sales model, utilizing an in-house retail network and online vehicle sales, completely bypassing the traditional third-party dealership system. The enterprise expanded its product pipeline by transitioning into the highly lucrative luxury SUV segment with the introduction of its second major model. This vehicle was designed to capture a broader share of the premium market and expand the brand's customer base beyond high-end sedans. The manufacturing framework is centered around a multi-million-dollar production facility in Arizona, which was planned to eventually scale to an annual capacity of over 100,000 vehicles. Additionally, the company sought to diversify its revenue streams by supplying its proprietary powertrain technology to external luxury automakers, including high-profile partnerships with legacy brands like Aston Martin. The overall market expectations were incredibly high, with early corporate presentations projecting a rapid trajectory toward profitability driven by high-margin vehicle options and international market expansion. The reality, however, has been characterized by a continuous series of production downgrades and executive transitions. The manufacturing framework struggled early on with severe supply chain friction, forcing downward revisions of initial annual production targets. The operational leadership has seen frequent changes, moving from early foundational executives to a period under automotive veteran Peter Rawlingson, followed by interim leadership under Mark Winterhoff, and leading to the current appointment of Silvio Napoli as Chief Executive Officer. Each leadership transition highlights the immense difficulty of converting world-class engineering concepts into a consistently profitable, high-volume manufacturing operation. While the underlying technology continues to receive critical acclaim from automotive journalists, the financial infrastructure has been defined by persistent capital consumption and widening operating losses. When analyzing the forward-looking landscape, the core tension between market expectation and operational reality will be determined by three distinct future scenarios. Comment below how many shares of Lucid Group Inc. you currently hold in your portfolio, and whether you believe the company can successfully fix its supply chain before its cash reserves run out. The first scenario involves a successful stabilization of the supply chain, allowing the company to completely clear its production backlogs and accelerate deliveries of its luxury SUV throughout the remainder of the calendar year. If the new executive leadership can permanently resolve the component quality issues with their seating suppliers, the company could potentially recapture lost market momentum and restore institutional investor confidence. This outcome would likely trigger a strong short-term recovery in the equity price, as short sellers cover their positions and premium retail buyers resume accumulation across mainstream online investment networks. The second and far more concerning scenario involves a prolonged operational slowdown compounded by expanding legal liabilities from the ongoing securities fraud litigation. If the court discovery process reveals that corporate executives intentionally overstated manufacturing readiness or covered up known supplier deficiencies during the class period, the financial penalties and brand damage could be severe. A lingering legal battle paired with any further delays in vehicle deliveries would severely drain existing capital and force the company to seek additional dilutive financing. For individuals managing personal accounts through modern robo-advisors or exploring self-investing options on standard trading apps, this scenario presents a high probability of capital erosion, as equity value is diluted to fund ongoing losses. The third scenario centers on a fundamental shift in the company's long-term business model, moving away from independent high-volume vehicle manufacturing and transitioning into a specialized technology supplier. Under this framework, the organization would lean heavily into its core strength of engineering elite battery packs and electric powertrains, licensing this advanced intellectual property to massive global automotive conglomerates. While this pivot would significantly reduce the capital required to maintain heavy manufacturing facilities, it would completely alter the investment thesis for current shareholders. Investors who bought into the asset expecting a dominant, vertically integrated luxury automotive brand would find themselves holding shares in a specialized component supplier, representing a complete misalignment between initial market expectations and ultimate corporate reality. To wrap up this comprehensive analysis, the core insight driving this asset is the profound disconnect between technological excellence and execution capability. The market expectation remains highly optimistic, focused entirely on superior battery range, prestigious luxury design awards, and the massive financial backing of the Saudi Arabian Sovereign Wealth Fund. The reality, however, is laid bare in the quarterly financial reports and recent court filings. A business model burning nearly $1 billion a quarter, severe delivery disruptions due to basic component supplier failures, and a significant revenue miss that has driven institutional capital away from the equity. While retail speculation continues to fluctuate across various investing sites and mobile brokerage apps, the long-term survival of the company depends completely on its ability to transition from a capital-intensive research project into a disciplined, flawless manufacturing machine.